Assalamualaikum to Madam and my fellow friends. Today we want to explain about Chapter 9, Bank Regulation and Management. First, we would like to introduce our group members. My name is Nabihah binti Muhammad Fauzi.
My name is Muhammad Iman bin Muhammad Saliuddin.
My name is Muhammad Zarif Shamil.
My name is Nuratul Ain Rabi Amin Talib.
Before we go through to Chapter 9, we would like to explain about overview of financial system.
The first one is financial system and institution.
It is a mechanism where funds can flow effectively from the surplus unit to the deficit unit. Three important components that complement each other: the financial institution, the financial instrument, and the provider and user of funds. The financial instrument are market instrument, bonds, and shares, whereas the provider and user of funds are participants. It is a borrower, lenders, and investor.
The second one is banking system.
It is as a central banker acting as the regulator and supervisor for the whole financial system, comprised of the commercial bank, including Islamic bank and investment bank.
Non-bank financial intermediaries.
It is important as it involves intermediation process. Intermediation is a process of efficient movement of funds from surplus to deficit unit. The role is to promote economic activities for economic development for finance institutions.
Money market foreign exchange.
It is where participants are able to meet their liquidity requirements by participating in the interbank deposits, a market for short-term movement funds among market participants by trading variety of financial instruments. It is essential market for corporations to complete their international transactions, a market that provides them with an avenue for the purchase of required currencies to convert the currencies received from the proceeds to local currency.
Capital market.
Capital market refers to the places where savings and investments are moved between suppliers of capital and those who are in need of capital. Capital markets consist of primary market, where new securities are issued and sold, and secondary market, where already issued securities are traded between investors. The most common capital markets are the stock market and the bond market.
For offshore market,
the term may be used to describe foreign banks, corporations, investments, and deposits. A company may legitimately move offshore for the purpose of tax avoidance or to enjoy relaxed regulations. Offshore financial institutions can also be used for illicit purposes such as money laundering and tax evasion.
Bank regulation and management, Chapter 9. This is overview for our presentation. For the introduction, banking business plays an important role in mobilizing funds among financial market participants. Financial statement of commercial bank. There is the bank balance sheet, liability, sources of funds and equity, uses of funds or asset, and the income statement. For the bank balance sheet, the bank balance sheet is representing the sources and uses of funds, the liability being the sources of funds and the asset as the uses of funds. It comprises of the three categories of assets: liabilities and shareholder equity. Liabilities, sources of funds and equity. Funds received by the financial institution from various sources including funds placed by the surplus unit in the form of deposit. It comprises of
Deposit by customer, deposit and placement from banks and other financial institutions, other sources such as bankers, acceptance and debentures and notes. The second one is capital and reserve that serve as a safety cushion for depositors. And the third one is deposit. Deposit are form of saving account holders, fixed deposit, and deposit for placement by other financial intermediaries. And the last one is sources of funds is the equity. Equity comprised of capital where funds are raised through the issuing of share capitals and retained earning, and is also comprised reserve.
this is uses of funds or assets.
It is to maximize its return and to meet regulators' requirement. Loans and advance dominating item on the asset sides of bank. Main business of bank is extending loans and advances to consumer as main contributor to the total uses of funds of the Malaysian financial system. This is typical balance sheets of commercial banks.
Other items as uses of funds of banks are
Cash and short-term funds, the liquid portion of term needs of commercial banks such as withdrawal of depositor and investment in banks' short-term investment. It is also an important indicator of level of liquidity of bank. Investment in marketable securities. The investment portion of the funds to maximize return for banks mainly insert short-term to medium-term investment. Deposit and placement with bank and other financial institutions. It is another alternative of bank investment which is the safest and become part of interbank deposit transaction. And the last point is statutory reserve with BNM. The placement with BNM as part of regulatory requirement.
The income statement.
Profit derived mainly from the bank loans given out and managing it to ensure risk minimized. Depends on the amount of interest paid to depositor as one of the main sources of fund. Net income interest (NII) is the main item in the income statement of a bank.
This is the income statement. Capital adequacy framework.
Provides protection for depositors and creditors. Capital in the financial institution includes equity capital, which consists of capital stock, surplus, undivided profit, reserve, preferred stock, subordinate notes, and debentures.
Function of capital.
To serve as a protection against any unpredicted losses such as interest rate risk, losses in value of asset due to unexpected changes in interest rate. Second, credit risk, chances that a borrower is unable to fulfill the terms of the loan. And the last one is operational risk, system and human resources issues affecting bank performance.
Measurement of capital. Managing capital is the most significant element in bank management. So it is always a concern with rate of return on owners' investment. So the objectives of central bank are to protect depositors and their deposit, to ensure a stable financial system, and to ensure a proper structure in the financial system. The approach used is risk-based capital. To explain more about risk-based capital approach.
What it is basically an approach based on the Basel Accord, which is a set of agreement recommended by the Basel Committee on Bank Supervision. It focuses on capital, market, and operational risk. So Basel I, which was issued in 1988, focused on capital adequacy. It categorizes assets of financial institutions into 5 risk categories: 0, 10, 20, 50, and 100%. So as you can see, there are 2 formulas there: risk-weighted capital ratio, which is equivalent to capital base divided by risk-weighted assets, and core capital ratio, which is equivalent to tier 1 capital divided by the risk-weighted asset.
Continuing, so basically this is a table to show how the calculation is done. So the higher the capital adequacy ratio, the better is the safety and financial strength of a bank. So this is a table to show the meaning of each category of risk. So for 0% means all claims on the federal government of Malaysia, OECD, countries and other Commonwealth and G7 countries. 10% means claims on guaranteed securities such as Cagam Mas Berhad. 20% means claims on guarantees of financial institutions in Malaysia, OECD banks, other non-financial institutions and NBFIs, and in Malaysia. 50% means all loans secured by mortgage on residential properties, and 100% means all other assets and claims not fall under the above categories. So 0% is basically the safest and 100% is the riskiest.
Liquidity management. So right now I will talk about the sources of liquidity, where there are 4 sources of liquidity, which are
New deposits, sales of assets, borrowed funds, and maturity of assets. New deposits are deposits from customers in form of fixed deposit, investment account deposit, deposit through savings account, and current account. Sales of assets are selling of short-term securities to be source of liquidity. Borrowed funds are a form of borrowing from other banking or non-bank financial intermediaries and even from the BNM. Maturity of assets are maturity of short-term securities, should be monitored closely by banks as part of liquidity management.
So now I will be explaining about the asset and liability management, handled by the ALCO, which is Asset and Liability Management Committee.
So basically I've made a flowchart here so we all can see what's really happening. So first, to manage banks' assets and liabilities to balance risk exposures and help achieve operating objectives. Then, to make sure adequate low-cost funds are available. Then we can talk about the strategies include, which is holding portfolio of assets that can be easily sold, acquiring a large volume of stable liability, maintaining lines of credit with other financial institutions. Next, the bank has to look at market risk, which changes in the market value of asset and liability. If the rate increases, bank will begin to earn more interest income on asset and paying more interest expense on liability. Interest expense changes more than interest income in short run. It directly alters the market value of interest-bearing assets and liabilities. When the interest rates rise, value of assets and liabilities fall, leads to a decline in net value. Potential sources of funds should be balanced against likely need of funds. Interest rate sensitivity of assets should be balanced against liabilities. So one of the scenarios where the ALCO goes through is, what if a bank experiences an unexpected large volume of deposit withdrawals? What if loan repayments occur faster than anticipated? Or what happens if interest rates suddenly rise by 100 basis points or 1%? So this causes a few challenges where there are two. So first is to assess probability that scenarios will occur, which is the three scenarios that I explained just now. And second is to position the bank to handle the most likely scenarios to reduce bank's performance and condition.
Asset quality refers to the evaluation of an asset to measure the credit risk associated with such as loan and advances. Lower credit risk means better quality of assets. Level of credit risk depends on three characteristics, which are the diversification of the asset, the regulation of rules, and the efficiency of the operations. Problem loan management. It is generally about financial institutions identify problem loan and later provide measures to recover the default loan to minimize losses. These are the problem in loan management.
Next, we will go to bank credit process, which is loan life cycle. A loan normally has to go through this process. First is business development. This stage where the loan product is developed and introduced to the market. At this stage, the promotional and other marketing activities will be performed by the bank to let the customers know of the existence of such a product and how this product is useful to the customer. Next, we go to credit analysis. It is the most important stage for the loan. Banks have to ensure that a sound lending policy is followed to ensure less chances of loan default. Banks have to ensure also that market condition is in favor of the business of the borrowers. Financial condition and securities are provided to protect the customer and the bank. It is at this stage where the credibility of the borrowers are being assessed through a widely used concept of known as the 5C of credit analysis. Third process is loan administration. It is the process of reapproval and reviewing certain terms of conditions. And the last stage is loan recovery. It sometimes may have problem in paying back the loan due to either poor management or conditions beyond the control of the borrower. Stage 2, which is credit analysis stage, which have 5 criteria we call as 5 C's.
First is character, willingness of the borrower to pay back the loan by observing or identifying the positive attitude. Second is collateral, what kind of asset that borrower can offer to protect against any non-payment of the loan. Third is capacity, ability to pay the loan based on the borrower's backgrounds. Next is capital, whether the borrowers have a certain amount of capital to start a business or to buy an asset. Lastly is a condition, an assessment of the condition of the economy to give such loan or not.
Problem loan detection.
This early indication is known as the red flags, which banks need to know at the moment when a loan starts to become a bad. It have 3, which is account operation signals, business operation signals, and environment factor. Account operation, which are community difficulties, issuing checks with insufficient funds. For business operations, profit trend declining, and increase in borrowing. For environment factors, overall changes in global competition, increase in entry barriers into the industry.
Next is loan recovery techniques, which have 4 approaches.
The first one is cooperative workout agreement. Second, collateral liquidation, enforcement of judgment, and bankruptcy. The cooperative workout agreement usually happen at the early stage. When bank notice any signal that the loan has potential to be bad, banks may start to negotiate with the borrowers. Negotiation between 2 parties, non-legal, and if both parties agree on the corrective measure, it will follow by implementation of the measures without involving court. Next is collateral liquidation, process of converting all charged security to the bank into cash to repay the loan balance including interest due. Okay, the third one is enforcement of judgment. Process is done when the borrowers ignore bank's proposal on corrective measures. It can be done for security value that are not sufficient to cover principal and interest due. court order of bankruptcy. Court will appoint creditor committee. Creditors committee will appoint trustee to take care of borrower's asset. Trustee will liquidate the asset and divides proceeds among many creditors, including the bank.
Measuring bank performance. The first point is profitability ratio.
First one is return on asset. Return on asset equal net profit divided total asset. Return on equity. Net profit divide shareholder equity. Spread. Interest income minus interest expenses divide total asset. Net interest margin. Interest income minus interest expenses.
The second one is liquidity.
First one is loan to total asset equal to total loans divide total asset. Liquid asset to total asset. Cash and short-term security divide total asset.
The next is asset quality.
Non-performing ratio equal to non-performing loan divide net loan. Loan deposit. Gross loan divide total customer deposit. Deposit to shareholder funds. Customer deposit divide shareholder funds.
The next one is capital adequacy.
Risk weighted capital ratio. Capital base divide total risk minus total risk weighted asset. Core capital ratio. Tier 1 capital divide total risk weighted asset.
And the last one is management soundness.
Administrative expense to total expenditures equal admin expense divide total expenditures.
So thank you guys for watching that presentation just now. I hope you guys learned a lot about Chapter 9, bank regulations and management.
Thank you for watching.
Thank you.
Thank you.
Bye.
If guys ada apa-apa soalan, boleh tinggalkan di comment section below, and then maybe give us some comments to how our presentation was. Thank you guys. Say bye.
Bye. Thank you.